Nikolaos Panigritzoglou of JP Morgan joins us right now on the show with his thoughts. Nikolaos, good having you. Thanks much for joining in. What's happened in Hong Kong, or what's likely to happen in Hong Kong with the election verdict, is leading to some gains across the Asian screen, and India is participating too. Do you think this will not be a short-lived move? Because this issue has been simmering for a while, and now it's showing some verdict, which is what the market would have wanted.
Yeah, I think there is a greater sense of normality in Hong Kong. It's difficult here to gauge the end game. There is no doubt that Hong Kong will never be the same based on what happened over the past months. But I think it looks like the demonstrators are losing some momentum here, and the government I think is also gaining some momentum from the fact that the population has been rather unhappy with schools shutting down a couple of weeks ago. I think that in a way means that the public might be supporting the demonstrators by less than before, something that would benefit the government and will in a way make it easier the return to some normality.
So Nikolaos, my question is, would you reckon that there could be some more positivity? We don't know what the outcome of the trade war is, but this move alone, do you think it could add some more legs to an Asian rally? We've seen the US markets do well. Can Asia now participate?
Yeah, I mean, Hong Kong is not a more important issue. Obviously, the US-China trade deal is a more important issue. But even that, I would argue, is not the most critical issue for markets globally. The most critical issue for markets globally is whether we are in a mid-cycle adjustment or a recession trajectory. And I think the most important news over the past month or so has been the idea, first suggested by the flash PMIs on October 24, that the global industry cycle is bottoming out, something that was reinforced last Friday. Of course, if we have a US-China trade deal to be signed at some point in December, a phase one deal, that will be good as well. But it doesn't mean that if we don't get a trade deal, everything will fall apart again.
Which is not the case in any case right now. If you were to look at what US equities are doing and also what our own equity markets are doing, which is trading really near its record highs. So the excitement around equities continues. We've seen a lot of liquidity in the US, particularly staying within the US shores. Is that something that's a trend you see in terms of returns for foreign institutional investors, and that therefore not having a lot of allocation to emerging markets and staying on US shores?
Yeah, I think if you think about the macro picture right now, if that bottoming out process in the global industry is indeed taking place, then the regions that have the higher beta to that is the Eurozone and emerging markets. These should be the regions that should benefit the most from that bottoming out process, and as a result, that should be these should be the regions that should get more flows over the coming months, especially by retail investors that had abandoned both EM and DM markets over the past year, and we believe that they will return, and it makes more sense for them to return to emerging markets given the higher beta to the global industry cycle.
Traders are also, winding down on their dollar long positions. What's the sense with regards to what the currency could do?
It's a lot more difficult here to gauge the trajectory for the dollar. The dollar has done nothing over the past year, practically speaking, despite the 10-year or 5-year treasury collapsing. by 170 basis points between November and August last year. So it's not clear here that interest rate differentials play the same role as in the past. I think there is an argument to be made here for some dollar weakness, given that cyclical picture that I described, the bottoming out of the global industry to drag the services sector later on and create some cyclical upturn. And when we get that cyclical upturn, the dollar tends to go down. But I think one of the offsets here is that the dollar is still a high yielder. Along with Canada and Norway, the Federal Reserve has the highest policy rate in the G10, even after the 75 basis points of rate cuts that the Fed has inflicted over the past months, and that should limit any downside for the dollar. So my guess is here of some mild dollar weakness, but not too much here.
Nikolaos, just one question. What's the positioning towards Indian equities in the multi-asset portfolios at JP Morgan right now?
I cannot talk about how JP Morgan clients are positioned here, but in general, India has been a positive story. So it's not an underweight market within the EM complex. I think other markets like Korea and more markets that are more like geared, if you want, to the global industry cycle that are likely to outperform. So India will do well as other emerging markets, but is not going to have the highest beta, given that in general investors are not that underweight.